It's been in the news lately that there's a looming sell-off for the U.S. stock market. Many different publications have been writing about this for the past year or so, and it's time to take a step back and see if there's anything behind it. Almost all of these articles cite the well-known Shiller P/E ratio as the indicator that's predicting the next big pullback. For those who aren't aware of how the Shiller works, it shows investors how much they're paying for earnings adjusted for inflation for a stock or for an index like the S&P 500 over the last 10 years. If you think about it, it makes a lot of sense. Would you rather pay $44 for $1 of earnings or $10 for $1 of earnings? And this is what these economists that work for these different publications are looking at. It's what's sounding the alarm. So today we're going to dive into what is going on and what to expect for the future. So Steve, I think we can both tell why companies like Vanguard and Forbes are writing about this. Can you tell us a little bit about how you've used the Shiller P/E ratio in the past and a little bit about what you know about it?
Grayson, I used the Shiller quite a bit from 1993 up to about 2014. Back then, what you could do is you could look at a long-term chart on the Shiller PE, and you notice when it got up to about 23, 24, it was peaking out, and it was time for a pullback. And what would have happened if you were playing it like that back then around 2013-14, you would have been selling out of the stock market, and you would have missed this run up for the last 12 years because it's been considerably over the 23-24 mark. You know, back in December, I believe it was 1999, it got up to about 44. So the big thing is that I think a lot of these publications are stating that now it's above 40, and typically in the past, when it's gotten that high, we've looked at a substantial pullback in the market.
That's a really interesting point because a lot of times these companies like Forbes, they'll look at this kind of thing and they'll really sound the alarm. We're in for a 40% pullback. I guess what I want to know from you, who's been around the block and has done this for a long time, does this level, the Shiller P/E ratio being over 40, does that concern you at all?
Some. It does some. You got to take that into consideration. But what is possibly could have changed is that just like 23 used to be where you really need to look at for the market pulling back, and it didn't happen. It could be now that this top that we used to have at 40, 41, 42, 43, maybe it's not any longer going to be the top. It could go up to 50 or 60. We just don't know. But it's something that investors should be aware of. They should be looking at it, and they should be paying attention of the momentum of the market, how earnings are coming in, and things like this. And really, just in case they need maybe to lighten up on some of their growth holdings, and maybe they should take a defensive stance.
Price-to-book ratio is a metric that used to be used a lot more often than it is now because it used to be more significant as far as being able to tell if a company was over or undervalued. Would you say that now Shiller P/E ratio is, I don't want to use the term obsolete, but it's in the same category as price-to-book as being a less significant thing to look at?
It has been for me over the last 12 years. What happened is in 2013-14, we went to cash, about 40% in cash, and we stayed 40% in cash for about 2 years, thinking the market was going to pull back in 13 and 14, and it did not. So we went back fully invested in 2015, and we really haven't looked behind us since then, and the market's been good to our clients. And so, I look at it, I consider it, but it doesn't play the role that it did 12, 15 years ago.
Can you tell us a little bit about why that might be the case? With price to book, intellectual property is taken more into account than it used to be, and that's why that metric isn't as effective. Is there any particular reason why that Shiller doesn't work so well today as it used to?
I think more than anything now is that what we have is a global market, and investors all over the world look for where they can get the most bang for their buck. They're looking for stable investments. So they're looking to the United States stock market. So we have a lot more inflow of money than when we did years ago. So what happens? It pushes up these ratios.
So, in short, do you think that our audience should buy into headlines that are predicting 40% drawbacks and sometimes even more?
Well, it's a possibility they could, but I don't think it's going to happen right now at this time. It could be sometime next year or the year after. There's a lot of times these newspapers, these publications will cry wolf, and there's no wolf around. And so you really got to be watching what you're doing. You need to trust if you're not doing it on your own. You need to trust who's managing your money, and just be aware of what could be around the corner.
That's a good word, Steve, because something like that is definitely something that we should be aware of. We're always watching for what's going on in the market, watching for headwinds. Right now, we're pretty optimistic about the end of the fourth quarter this year. So just if you have any questions, feel free to let us know. You can contact on our website or leave a comment down below, and we'll be happy to talk a little bit more with you. Until next time, may God richly bless you.